So this is another video that falls underneath the depreciation expense calculations. This calculation we're going to talk about is the production method, or sometimes it's called the unit of production method. Both of them mean the same thing, but what they're doing is they're recording depreciation expense based on how much units come from this particular long-term assets or property, plants, and equipment. In most instances, this type of depreciation expense normally goes with things like equipment, um, mostly equipment. Yeah, because equipment are the devices that can produce units, whereas a building can't really produce a unit of item to be sold, or a vehicle can't do it. And so, therefore, this mostly happens or can be used when we're trying to depreciate a piece of equipment. This is an equipment that's big enough to produce a whole unit. So this probably is a manufacturing company would definitely use this method more than any other type of company would. The premise is that when a company purchases a piece of equipment or asset, they try and determine or give an estimate for how many units they think the asset can produce. And so, based on that information, they use that to determine how long the asset will be useful for. And so, it's slightly different because they don't give you years. They normally don't give you years for equipments like these, because depending on the amount of units it produces, then that's kind of how it's depleted, or how the equipment gets older or more fickle and loses its value as units are produced, not really as years go by. Because technically, if you have an equipment and you haven't used it for 2 months, for those 2 months, you don't expect it to really lose value, because it hasn't produced its max yet. It hasn't added to the total that's considered to be the max amount of units this particular equipment can produce. And so that's kind of the thought process that goes behind this method. This method isn't too bad. Similar to the double declining method, uh, the amount that's recorded as depreciation expense each month differs. But the only difference is it differs based on how many units the equipment or the asset was able to produce in comparison to how much is expected to produce in its lifetime. And so let's look at the modified information that I have over here. This is following from the same example we started with equipment valued at $314,500. And this time we're going to continue to record the depreciation expense for equipment that is expected to produce 100,000 units of products with a salvage value, or in the book they call it residual value, of $50,000. The units produced for the first 2 months as follows. In August, 2,000 units were produced. September, 4,000 units were produced. Record depreciation expense for the first 2 months. Okay, and so what I like to get started with definitely is, let's get started with a formula. So the depreciation expense formula under the production method is cost minus residual or salvage value divided by the estimated units of useful life. So this differs from the depreciation expense underneath the, what's it called, underneath the straight line method, sorry, slightly, because the figure at the bottom is the estimated number of years that is useful for, but in this case it's the estimated units of useful life. And so what that means is that every month we have to do a calculation to determine how much we're going to depreciate this by. And so this is the formula. And of this formula, we usually get a rate. And that's the depreciation rate that we're going to use. And we take that rate and we actually multiply that rate by the units produced each month. So I'm going to leave it unit produced. And so let's just calculate the rate now using this formula. So it's going to be equal to the cost, which is $314,500, minus our residual value, $50,000, divided by the estimated units of useful life, which they said is expected to produce 100,000 units. And so we would divide that by 100,000, and we got a rate of 2.65, and this is actually a rate of $2.65 per unit. Okay, and so when we want to determine the depreciation expense that we use for each month, what we have to do is we have to take this $2.65 and multiply it by the amount of units that was produced in that month. And so let's get started here. We can get started with the month of August, and depreciation expense is normally recorded at the end of the month, so that'll be August 31st, 2020. And of course, our entry does not change. Depreciation expense, accumulated depreciation equipment, doesn't change. Doesn't matter the type of depreciation calculation used. It's always going to be the debit or depreciation expense and the credit depreciation equipment. The only time that happens is if we're reversing or taking out depreciation expense or taking out accumulated depreciation. That's really the only time that happens, which doesn't happen often unless there was an error in the posting. And so now to calculate the amount that we're going to use, the amount is going to be based on the rate, 2.65, this formula here, rate times units produced. For August, units produced was 2,000 units. And so it's times 2,000 units. We have $5,300 here as our depreciation expense. And so the accumulated depreciation is going to be 5,300 again. It's the same debit and the same credit. Record depreciation expense. Now, at the end of August, that means that our balance sheet would show equipment as $314,500 and accumulated depreciation of $5,300 with a carrying value of $309,200. And this is what would have happened at the end of August. Now let's move on to September. And by September 30th, we should already have an idea of what our depreciation expense should be. Let's copy this entire entry because it's going to be the exact same entry, debits and credits. The only thing that's different is going to be the amount of the depreciation expense, because we now have to change our formula. It's still the same $2.65, but now they're saying that they produce 4,000 units in September. And so that means for the month of September now, based on the calculation, depreciation expense would be $10,600. And so $10,600 as added to our accumulated depreciation. We can add that here as well to show us a new carrying value, which would be $298,600. Okay, and that's pretty much it for the production method. What you'll notice is that the production method isn't as friendly, I would say, isn't as friendly as the other two methods, because the other two methods were a bit lower in depreciation expense. But it all depends on what type of method is selected and the different things that go into the calculation for the method, because if they had said they expected 1 million units, then this would have completely gone down a whole lot more. But because it was only 100,000 units estimated to come from this piece of equipment, then, I mean, using up 2,000 in August, 4,000 in September, that's already 6,000 units used. It's probably going to get used up fairly quicker than the other ones underneath the double declining and, let's say, straight line, which were 20 years. So based on this information, I would expect that this is going to be fully depreciated before 20 years. But yeah, that's I guess my assumption based on the information provided, or the information that I actually made up. But that's just a look into how accountants can actually look at this stuff and make decisions or understand, be able to compare and contrast companies as well, just by looking at something like depreciation expense. The production method is fairly easy as well. I think all of these depreciation methods are. Double declining may be the most challenging, but once you follow the formulas given, um, it's difficult to go wrong. The entries are always the same, in the same order, with just different figures. And I thought it was important to add this balance sheet look, just so you can see how each transaction affects the balance sheet each month. And so, again, hopefully this video helps. If there are any questions, feel free to post them, and I'll answer them as quickly as I can. But happy studying.